Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about rolling options. It's fairly simple, but there are plenty of misunderstandings when it comes to this, and you're brand new to options trading. So I want to fill in some of those gaps for you today, hopefully help you out. So I've got some live examples, and we're going to talk through this and how it exactly works. So if that is what you're looking for, please stick around. Whoop. So if you are new to options, rolling an option simply means that you're closing out your old contract and you're entering into a new contract all in one easy step. Now, if you were a buyer of an option, right, you bought to open a position, now you're going to sell to close that position, and then you're going to buy to open a new position. If you're a seller, in this case, you sold to open a position, now you're buying to close that position, and you're selling to open a new position. So that's all rolling is a two-step process where you're closing out the old contract and you're adding in a new contract. Sounds pretty simple, right? So let's set up an example and talk through all the different scenarios that could occur. So let's use the world famous stock XYZ, trading at $100 per share. Let's say we decided to do a covered call strategy with this. We went out and we bought 100 shares, right, for $100 each. So we have $10,000 invested in this trade. We decide to sell a covered call. We pick a strike price of 105. And for doing that, out 30 days from now, that's our expiration date, we collect $100. Are you with me? So we have two important numbers now that we should keep track of. One is our basis, right? That's how much we have in this trade. So we paid $10,000 for our shares, but we collected $100 in premium value. So really we have $9,900 or $99 per share. The other number that's important is our break-even value for this individual trade. So on the option, it's going to be our strike price of 105 plus the premium that we collected, 106. So above this, not so good. Below this, that's a good number for us. So as long as it stays underneath 106, we will make money on this trade. So time ticks away and you find yourself on that Friday day of expiration, sitting down to lunch and evaluating your position, right? You take a look at it. Now, there's generally three scenarios, right? It could trade sideways or maybe go down a little bit. In that case, the option is going to naturally expire. You don't have to really do anything. You might have closed it out earlier, but you don't really have to roll it in this case. You just let it expire and sell your next call on Monday and adjust your basis. Simple enough. But the perfect scenario, and what we're really hoping for when we sell a call, is that it targets that strike price that we're looking at. So in this case, we picked 105. So if it goes right near 105 on the day of expiration, that's the perfect situation. You are now in the driver's seat to do whatever you want. You can let it get called away. You can do whatever you want, really, in this situation. You hit the target. But in this case, today we're talking about rolling options. So in this case, you look at it, you're like, okay, I got $100 up front. If I want to buy to close right now, it's going to cost me maybe $2, $3. I don't know. Let's use $2. And then you're going to sell your next call. So you roll it, and you're going to sell your next call, and you're going to be able to pick any strike price that you want. You could roll it down, you could roll it out, you could roll it up. That'll depend on how much premium you get to collect now. So are you bullish, bearish, or neutral? So in this case, we would add all it up. So let's say we collected $100 for our first call, cost us $2 to close it. Now we're going to sell our next one for we'll collect 150. I don't know, whatever strike price you pick. So altogether, you'd be up $248. And that's how you would adjust your basis. You take that against that original $10,000, adjust it, and you'll see that your new break even is now, what, $97.50 or so. So you're doing pretty darn good in that situation. Now for the tricky one that confuses everyone. This is the one where the situation is that, Monday it's 104, then it goes 105, 106, 107. On Friday, you're sitting there, you're eating your lunch, and you're like, wow, it went right past my strike price. I guess they're going to call it away. But no, that's not really the case. Typically, they're not going to take your shares away. They're going to allow you to go all the way into expiration. We can talk about why in another video, or if you have questions, just ask me down below. But at 107, you're going to sit there and you're still going to be able to roll this call out. So that's our focus today, again, rolling the call out. So let's talk through how this might actually look. We're near expiration. So you collected $100 up front. Now, if you go to buy to close, you're going to look at it and it's going to be, wow, it's at 107. And my strike was 105, so it has $2 of what we call intrinsic built-in value, right? So it's got about $200 in there. It might have a little time value too. Let's say it has $20 of time and IV in there. So altogether, buy to close is going to cost you $220. Darn it. What are we going to do? Well, you're still going to be able to roll it out for credit when you sell to open your new contract. So when you sell to open your new contract, you can probably roll it down again if you're bearish for the next month. You could roll it down and collect a larger premium, but understand that you're willing to sell it, let's say at 104 for less money. You could roll it out and keep your 105 strike price and probably collect like $400, just made up numbers, or you could roll it out and up to your 107 strike price, and my number in my head would be like 300 bucks. So in this case, you got 100, and then you're going to take 220 off to close it, and then you're going to add 300 for selling your next call. So altogether, you collected $400 minus your 220, so you're up 180. So again, we're going to adjust our basis and look at it and say, okay, we feel pretty good. We put more credit in there, and now we're offering to sell it at 107. So at the end of the month, for example, let's say we just let it get called away and called it a day on this trade, you would have gone from buying it at 100, selling at 107, and collecting $180 in credit. So you'd have 700 plus 180, so 880. Done a great job. It looks really good. But just understand that just because it's above your strike price, you don't have to worry about this. You can just roll it out and roll it up. Now, if it gets too far away, if it goes 107, 108, 110, 115, it's going to start getting to that point where you can't roll it out and up. So at that point, you might just have to let it go. But just understand that when you're just a little bit above that strike price, 2, 3, 4, 5%, you're still going to be able to roll it up and out. And I've bought plenty of time with trades. You'd be amazed at some of these that have gotten away from me over periods of time, and they've come right back to me just by rolling out my options. So I want to jump in and show you some examples first. And this is a call on Kinder Morgan. This is the stock that I've been trading with. I've had these shares all year, going back to February of this year. And currently it's at $16.58, but it's been all the way up to $20. And I haven't really deviated from the $17 call. I've just been rolling it out. And that's paid off pretty well because it's come all the way back down to $16.58, but I've collected a heck of a lot of premium. And my average price right now, or my basis in this stock, is about $15 per share. So it's been a really good trade for me. Now, you can see in this particular one that's open right now, it expired this last Friday, and this is a snapshot as of Thursday. So in this case, I sold this for $189.95, and I've collected the vast majority of it, or 96%. So there's only a little bit of value left, $6. So this is going to naturally expire if I let it, and that's actually what I ended up doing. But as of this Thursday, I took some snapshots here to kind of show you what it might look like if we did some different strategies here. So the first one is if I just rolled it out and down. So in this case, if I wanted to sell my next strike at $16.50, because let's face it, the oil stocks have been getting hammered lately, maybe that would be the one that puts the most profit in my pocket and allows me, again, to have a little bit of downside protection, because with the stock at $16.58, that's pretty much at the money. So this is the max premium that I could collect and still be kind of at the money. So in this case, I would buy to close those 3 contracts that are existing right now, and I would sell to open 3 more out 1 month to August 12th at a $16.50 strike, and I'd collect $151. So that is one option. Did I do that? No, let's keep looking. So here's the next one. Let's say I rolled it to a $17 strike. So in this case, I'm just rolling it straight out. In this case, I would do the exact same trade, same expiration, but I'd only collect $88 in premium. But in this case, I keep the shares as long as it stays under $17 underneath that $17 strike. So that's another option. Now, how about if I think, okay, well, oil's given up quite a bit. I'm pretty bullish. I think it's going to rebound back up. I'd like to make sure I retain these shares, so I'm going to roll up. Well, that's this third one. This is a $17.50 strike that allows me to have much better control of these shares if I'd like to do that. In this case, I would buy to close 3, sell to open 3, same expiration, $17.50 strike. For that, I'd only get $46, but still, it's not. I don't have a whole lot in this. It's 300 shares at about $16.60 is my average price. Like I said, my base is down to about 15, so I've got about $4,500 in this. So $46 is not bad rolling it out a month. So what did I end up doing? Well, as of Friday, I just decided, hey, I'm going to sell naked calls against this because my one is going to naturally expire. I have a video, I'll link that above, but that, some people like to do that. Some people are very opposed to doing that. So in this case, the one expired. I've already recorded that, and I decided just to sell out that $17 strike, just kind of basically rolling it out, and I collected $105.95. So feel pretty good again about this going out. My basis is quite low. I really like the dividend that Kinder Morgan is paying me, so I'm going to continue to try to kind of retain these shares, but play as close to at the money as I can. Now, this next example is LYB, Llano-Basell Industries. They are a chemical company and supply lots of plastics that I actually use all the time. So I'm familiar with the company, and if you like dividend stocks, this might be one for you to check out when you get some time. But current price as of this past Thursday was $83.60. And this is an example of where I've sold a put at $84.80 and these shares would be getting assigned to me. So I decided, let's take a look. Maybe I should roll it out and down. So again, this is a put where I've offered to buy these shares, allow them to get put to me if they fall below a certain price. So I'm looking at this $84.80 and I'm kind of playing defense on a lot of these stocks right now. So in this case, when I sold this, I sold it for $92.31. But right now, the current value is $165. So I've lost quite a bit. I'm in the hole, $72.69. So what are my options? Well, like I said, I'm kind of playing defense. So I started looking at how can I roll this out? And again, this was on Thursday. So this first one, this is an example of rolling it out. So give myself another month for Lena Basel to kind of balance itself out and see if it kind of can recover. And I can do this, and I can buy to close that one contract, sell to open another contract out about a month. Now this only trades once a month, so August 19th is my only expiration that's out about a month. Same strike price, and for that, I would pay about $155 to close it, or $165 is the ask. I would get about $450, so I would net out $283.70. So I could reduce my basis overall on this stock, and I would have a break even. Then I could go $2.83, or I should say $2.83 below my $84.80 strike price, right? So I'm adjusting down. I'm gonna be able to put that credit in my pocket. If it recovers, I'm just going to keep all that myself. So that's one option. But I wanted to look further too and see, could I roll this down to protect myself again, play a little more defense? And I certainly could, because if I sell to open that August 19th and I take $5 off of that price down to the $79.80 strike, that's a big difference too. I don't get to put as much in my pocket, but it's got to fall an extra $5. So that's an extra $500 that I get to protect myself with. So in this case, I would net out between that $1.65 and $2.35, $68.70. That's really interesting, right? So extra $500 worth of quote unquote protection, but I still get to put some money in my pocket this month, $68.70. Now, what I actually did was I waited till Friday, it recovered a little bit, and this is what I did. I decided to roll it out and down. But I went even further. In this case, I rolled it all the way down to a $74.80 price. $10 below where it currently sits. And since the stock recovered a little bit, it only cost me $35 to close it, and I got $99.31. So I still did okay, made a little bit, and I have a lot of protection. So it's still got to drop $10 in value. That's pretty big, pretty significant, from 84 all the way down to 74.80. So I feel pretty good about putting a little bit of money in my pocket. And if this actually falls to $74.80, I feel pretty good about having this put to me. So that's how I handled that trade. I feel pretty good about it. And again, that's just illustrating the power of rolling options like this, and always kind of looking out and seeing where things stand at the end of the month before you let something, an assignment takes place. Take a look and see what you can do. So there you go, a couple different examples of rolling out calls and puts. And of course, you can also do this if you're a buyer. But I wanted to do this video because I've been having lots of requests from people about poor man's covered calls and exactly how that strategy works. And it's a multi-leg strategy, and I really think you should understand rolling out options. So I kind of want to cover this real quick before I do that video. So I should have that one coming out here shortly. If you like that kind of thing, please like and subscribe. But otherwise, I really appreciate you taking the time to watch this. Thank you so much. Any questions? Ask down in the comments. We'll see you real soon. Have a great night. Whoop.